Well, hello, this is John Yates, and I chair the technology practice at the law firm of Morris, Manning & Martin. And I'm pleased to be here today with Lyle Newkirk. Lyle is a friend that I've known for many years and one of the most talented CFOs that I've had the pleasure of working with. And Lyle has worked with early stage companies all the way through growth stage, through multiple financings, even an IPO. So he's one of the most experienced CFOs that I've had the pleasure of knowing. And Lyle and I are going to talk today about a couple to several questions that every entrepreneur, every CEO and CFO of a company should know and be aware of, because they're the kind of questions that they're going to get asked by investors. So Lyle, maybe to start out, tell us a little bit about your background.
Well, sure. Thank you, John. You're right. I've been in technology for a long time, mostly as a CFO, probably a real long time. I go all the way back to MSA. And for those people who have been in Atlanta for a while, you probably know that MSA was the grandfather of so many technology companies here in Atlanta. I was CFO at Peachtree Software, another name that a lot of Atlantans will recognize. And we had tremendous growth at Peachtree and began an acquisition binge for Peachtree that ultimately led to their merger with Sage. They're now known as Sage North America, as you may well know. Following Peachtree, I was with TR Systems, which handled imaging software, and we took TR Systems public in 2000, shortly before the big crash. But we were profitable, had real cash flow and real customers, unlike a lot of the tech companies at that time. TR Systems was eventually sold to Electronics for Imaging in a very successful strategic sale. At that point, I moved on to a healthcare company called CareCentric. Worked a lot with your firm, John, at CareCentric, as you may remember. We did several M&A transactions at CareCentric, but ultimately, when funding started drying up in 07 and 08, I moved on. Went to Corrigo, which is a company that helps people manage their facilities. Corrigo's a SaaS company, always has been, was almost out of business at the time I went there. We salvaged it, brought it back, grew the revenue, and in 2015, at the end of 2015, we engaged in a very successful strategic sale to commercial real estate giant Jones Lang LaSalle, known as JLL. Since then, I've been part of JLL Finance. It's been very interesting. It helped us internationalize the product. We're now in over 100 countries, 23 currencies, and I think 21 languages. So it's been good growth pre-JLL and good growth post-JLL. Recently, I left JLL as part of an overall reorganization of their finance team. It was a friendly departure. So I'm presently looking for my next opportunity in technology.
So Lyle, you're one of the hottest free agents I can think of out there in the CFO world. And you and I have chatted a little bit about some of the key questions that are important that you've seen over the course of your career. So let's just jump into them. One of the questions is whether a company has a dashboard or a key set of metrics that's reviewed periodically by the management team. It seems like something fundamental, but tell us a little bit more about the importance of that and what some of those key metrics have been in the course of your career.
Sure. And you're right. It does seem fundamental. It seems like something you would just do as the back of your hand. A lot of people don't, though. If you don't do it, I recommend that you do so. Your board may insist upon it. But you want to make sure that you've got a set of key metrics that you're reviewing with your management team in a regular cadence, ideally monthly. You want to make them easy to understand. You don't want to have fights over how the metrics are calculated. Keep them simple. My advice is stick to about 10 to 12. Don't overdo it. You can easily come up with 50 or 60 and people just get lost. Their eyes glazed over and nobody wants to go to the meetings when you do the review. If you think you need additional detail, do drill downs from those 10 or 12. My advice, and of course you want to do what works for each company, but is you probably want a couple of metrics on sales, maybe most recent results, and maybe pipeline. I think you're going to want a couple on customer support, etc. I think you're going to want to have, for sure, a metric on customer attrition, i.e. churn. Very important. You probably are going to want to have something on marketing, maybe leads tracking and marketing effectiveness. And then I think you're going to want to have a few financial metrics as well. Probably cash flow is what matters to most people, maybe expense levels, maybe headcount. Keep it high level like that. Oh, one other I would throw in, I guess, is deployment. I would have something in there on trends in deployment to make sure that you don't have some kind of backup in getting your customers live. But keep it simple like that, keep it high level, and it'll be something that everybody can use.
So Lyle, is that also a dashboard that you would share with your board of directors, or do you boil that down to something a little shorter that you share with them? How does that work?
Yeah, so everybody's going to do it a different way. In my case, I want my management team seeing what my board of directors sees. And I want them getting the feedback that we get from the board. So if the board's unhappy about a metric, I think the management team needs to know about it. But the important thing is we all need to be talking the same language. And you don't want to have one set of communications with your board, another set with your team and your staff. It's not going to work. Problems are going to come up. So my advice is be consistent. Use the same data, come up with the same questions, and make sure you do it on a regular basis, ideally monthly.
So another key question here that sort of ties into that is, how do you know if you're putting enough focus on sales and marketing? What's the right balance, and how should an entrepreneur think about that?
Yeah, so since I'm a finance guy, John, you may think I'm concerned about overspending on sales and marketing, and that can happen, believe me. There is an equal danger that you're underspending on sales and marketing. And I think that happens a lot with technology companies. You can easily plow all your money into engineering and possibly into customer support, and your sales and marketing suffers. And then all of a sudden you're wondering where your revenue is. You want to make sure you get this right. So you want to make sure you're benchmarking against other companies. You want to benchmark against your industry, benchmark against your competitors. If there's public companies out there that do what you do, try to see where they are on sales and marketing as a percent of revenue, and try to figure out why you're higher or lower than they are. It's very important. So you also can probably find some standard industry metrics on sales and marketing, and you want to benchmark against those too. Now, I come out of the SaaS world, okay? And there's tons of metrics on SaaS. There's some real good ones out there. KeyBank Pacific Crest puts out a great set of metrics every year, and you want to benchmark against those kind of metrics. Know why you're where you are, and make sure your management team knows why. Your board's probably going to look at them at some point and ask you the question anyway, so make sure you know them. So I guess to answer your question, again, it's just basically look at the benchmarks, find them, figure out where you are, and see if you're over or under spending, and then you need to act accordingly.
Very interesting. So let's pick up on that concept also and look at sales and marketing and think about sales comp plans and quotas and how those work. A lot of companies struggle with that and lining those up with the overall mission and financial forecasts of a company. What's the best way to do it? How do you know when you got it right?
Mm-hmm. A lot of people do struggle with that, John. And, I've seen it in a number of places. We had to do a fairly serious revamp of our comp plans, quotas, and sales programs at Corrigo a few years ago because one part of our business had stagnated. And sure enough, after a couple of very hard months and some tough conversations, we got it right and sales began to immediately pick up. My take on quotas, and this matters a lot, how you set those quotas, is you want the quota to be like par in golf. In other words, it needs to be what a reasonably good salesperson can do under reasonably good conditions with reasonably good marketing support. Figure out what you think that salesperson should be selling per month or per quarter. People do it a different way. And that's my take on where the quotas should be set. Other people have different opinions. Some people like to say, no, we want to set them so only about half of our people meet quota. I guess you could do that too, but I think the main thing is it needs to be something that's easily understood. It needs to be attainable. If nobody can hit quota, you got a problem. Maybe you've got all lousy reps, but more than likely you set your quotas wrong. So think about what they should be doing and set your quota accordingly. And you mentioned how it fits into your overall financial plan. It definitely does. The quotas aren't an island. You don't just have them sitting out there so that you can calculate commissions. They're important. You want to make sure that the sum of all quotas set after establishing some kind of discount for non-performance ties into the amount of sales you need to hit your revenue plan. I mean, it's as simple as that. And in the financial plans I've put together, that's often the most important component and often the most contentious.
You see companies.
I guess another thing I would say is you want to manage toward those quotas. A sales rep needs to understand that you're a results-driven company and you expect performance. And at some point, when performance against quota isn't happening, it's an HR issue. A performance plan probably needs to be put in place, and ultimately perhaps termination. But you want to be consistent. Okay. You don't want to have one set of standards for one rep and one for another. That's why quotas are so important.
Very interesting. It's obviously very important too. I think when you're presenting that to your board, I've sat in a lot of board meetings. I know you have as well. And there's nothing more frustrating, I'm sure, for you as a CFO when you have to put up the slide that shows, the forecasts were missed and nobody's getting, meeting their quota. It's got to be demoralizing in that regard too. So I'm assuming there's adjustments that are necessary, if it turns out that the quotas aren't set correctly. I mean, is that something you've had to face as well?
Absolutely. Okay. And, and conditions change. Look what happened this year. We were flying high in January, and people were buying, the economy was rolling along. And by March 17th, the world had changed. Now, interestingly enough, in my most recent company, we did not have to adjust quotas. We were able to keep deals moving, but not everybody could say that. I think you're foolish if you're not looking at your quotas at least quarterly or semi-annually. It may sound great in January when you deliver the comp plans. By June, conditions may have changed and you may need to make some kind of alteration. What I've done with sales comp plans is I put in language that says management has the right, or management may revise quotas up or down quarterly as business conditions warrant. The best scenario is sales are going well and you're bumping those quotas up a little bit versus wondering why you're not hitting them. But I think you want to make sure you have that flexibility, and reps need to understand that it could change. That needs to be very clear.
So let's turn to customer satisfaction. In the technology area, a lot of these companies start moving fast. They'll start signing up a lot of customers. Customer success folks turn into really customer complaint folks. They're just dealing with complaints. How is the best way for a technology company to measure customer satisfaction?
Well, so first of all, you want to make sure you are measuring customer satisfaction. I'm not sure everybody does it, but it's critical that you do so. And you may know, John, that there's some great tools out there that have come along in recent years, some great software products that let you do things you just couldn't do even 5 years ago. And they're fantastic. They're also kind of expensive. There's also all kinds of new measurements in place. NPS is one that comes to mind, but there's others. So there's no shortage of ways to measure customer support quality. However, for some smaller companies, some of those things may either be too expensive or maybe too complex. And if that's the case, you want to make sure that whoever's managing your customer support is getting regular feedback from as many customers as possible, as frequently as possible, and that feedback is being communicated. And you don't want to take, the customer didn't want to respond to our survey as a reason for not getting the feedback. You got to be getting it. It's got to be measured. And that's why I said earlier, I think it needs to be up in your key metrics or on your business dashboard where everybody can see it. It needs to be consistent. It's something that the entire team needs to be measured against, not just the customer support people. It could be an engineering issue. You could have sales and marketing issues. Heaven forbid, you could even have finance issues that are causing customer dissatisfaction. You want to know. A couple of other things you can do is periodically do a deep dive on your deployment pipeline. And you might say, well, there's not customer satisfaction yet because the customer's not deployed. But you want to make sure that deployments aren't going badly, aren't taking too long, aren't turning customers off before they even go live. You want to make sure they actually do go live. I've seen cases where you run the customer through the deployment process and they say, not for me, I want out. So do those dives on your deployment and make sure that component of your service offering is being managed correctly. And then finally, as a finance guy, one way you can be sure customer service or customer support is not lacking is do periodic deep dives with your customer service people on your accounts receivable. Know why people don't want to pay you. And you can often find a problem very quickly if you just do a deep dive on your AR. AR is not just an issue for your accounting manager and your controller. You want to know why people don't pay because there's often a business problem underlying the issue.
Those are great points. So let's shift to something in the legal arena that we're oftentimes dealing with, which is IP protection. And the issue of IP protection and IP ownership claims and the like, I'm assuming that as a CFO, especially where the company might not have an in-house counsel, you end up having to face those issues as well. How have you dealt with those in the past?
Yeah, you're exactly right, John. The CFO, in my opinion, ends up with that, even though it's not necessarily what you learn when you go to CFO school. You're going to get stuck with it, okay? And where it's going to hit you, if it's not done right, is when you have some kind of liquidity event or financing and somebody's doing due diligence. And then it can hit you hard if you're not prepared. So there's some basic things you can do. I mean, you can hire a great firm like Morris, Manning & Martin to help you do it, and they can even do it for you. But I think that might be a little bit of overkill. You're better off just sitting down and talking with them and saying, we need a plan for making sure we've got our IP ownership locked down. And the plan is pretty simple usually. It's, okay, find all points of entry to your product. All employees who are working on the product or who have worked on it should be on the record for work for hire agreements, okay? That's got to be part of your new employee setup. It's not something you get some of your employees to do. You don't get a paycheck before you sign off on that right to hire. Same with contractors. Don't pay until you're sure you've got it nailed down. Same with third-party software that you've incorporated. Make sure you've got the proper ownership rights in every license agreement for every little piece of software that goes into your product. And my advice is, and it's a little bit painful, do an audit, okay? It's going to take you a few months to work your way through it, but do an audit. Sit down with your engineering guys, figure out every point of input, and go make sure you've got yourself covered documentation-wise on your IP rights. Again, a good law firm, and Morris, Manning & Martin is a great one, can help you with that. But it's going to end up falling to a guy like your CFO to make sure it gets done and that it stays done. Again, big point, don't wait till you've got an event to do it because you're already too late.
That's great advice, Lyle. And clearly you've been through this drill many times, so you've seen the problems. When we're working with a company, an early stage company that's just starting out, we can set forth that game plan for them and explain the importance of intellectual property ownership and assignments and copyright protection and looking at patent issues and the like. Where it's really a challenge is where you come into a company that's gotten ahead of their skis, where they've out there been doing lots of different things with lots of different people, contractors, exporting people out of the country, and then you have to sort of piece it together. As you point out, it's really understanding the history, and we oftentimes suggested the company they build and write the product chronology. Start with the beginning of time and run through, and then we take a look at that with the CFO. So those are great points.
That's right. The product chronology can matter a lot. But you're right. People get out ahead of their skis. And it's great. You're having a great time. You've got a great product, great concept. You think that you can become a high flyer. And everybody's going 90 miles an hour trying to get there. And, so don't mean this the wrong way. It's not the most exciting or glamorous part of the work. And you're not going to get people interested in it until it becomes a problem. And then they're very interested. So take the time, do it right. You need a guy like a CFO who understands those things to make sure it's getting done. Your board will support you on this if the rest of your management team won't.
So let me ask you a final question, Lyle. I'm fond of telling our clients, especially early stage and fast growing tech companies, when they bring an investor on, that every board meeting is a performance review. That everybody that presents at that meeting is getting reviewed. And usually the investors are only seeing it, let's say, once a quarter. And so it's very, very important. But I also focus, and we have a pre-board call that we generally have with our clients. And we say, look, give us just 15 minutes where we talk about what we've seen as the issues du jour that you're going to likely get. One of those key issues, and we alluded to this earlier, are the sales forecasts, because all this other nicety sort of goes by the wayside. And oftentimes you find the board member saying, look, get to slide 20. I want to see the forecasts. From your perspective, what kind of interplay needs to take place between the CFO and that VP of sales in building that forecast? And how do you make it work? Because I've seen many, many times where, the VP of sales makes that presentation, and unfortunately they miss the numbers. And so who does the board look at? They look at the VP of sales, but when the VP of sales leaves the room, they're sitting there attacking the CFO, saying, how in the world did you let this happen? Tell us a little bit about your experience, maybe as a final question here. This is really, likely to happen to a lot of tech companies where the CFO faces that dialogue and has to figure out how they work the forecast out with that VP of sales who's telling them that, assuring the CFO that the numbers are going to be made, and then they're not.
Well, of course, the CEO owns it too, John. So it's really a three-part thing. But one of the things that I've learned, and that's been helpful to me, is that a lot of times there's a very contentious relationship between finance and sales and marketing. And it can be toxic in some cases. In fact, I replaced a CFO once because he couldn't get along with the salespeople. You need to take the exact opposite approach. I think the CFO needs to be best friends with the head of sales. I think the CFO needs to help that guy or that lady put together their comp plans, help them with their quotas, put together the numbers, go through the cadence, go through their pipeline, ask the hard questions. Make sure that the salesperson realizes you're not attacking them when you say, this doesn't add up. This doesn't make sense. Be their friend, be their helper. And if you're a good CFO in a technology company, in my opinion, you should be spending half your time on revenue growth, which really means half your time on sales, because expense control is not that hard. A lot of the other things aren't that hard, but revenue growth is hard. So go put your energies there. So establish that relationship with the head of sales. Go through all of his or her forecast ahead of time. Make sure the CEO is involved and try to have the best possible data. Having no forecast is a bad answer too. I've seen that where a salesperson doesn't want to commit. Well, to me, that salesperson needs to be gone if they're not going to commit to some kind of forecast. But I think practice makes perfect. I think review makes perfect. And asking the hard questions ahead of time helps a lot. And then be forthright and be transparent. If the sales are bad one quarter, don't try to make them look good. Just tell the board, hey, we missed it here, we missed it here, we missed it here. Here's what we've done. Don't try to cover up. But I've seen people try to do it all the time, and it doesn't work. So it's communication, transparency, preparation, a lot of hard work, and an important and very solid relationship with your salespeople is, I think, the best thing you can do.
Well, those are all great points, especially in that last one, the idea of helping that VP of sales and being in close relationship with them as a CFO, helping to go through a rehearsal, because frankly, if you're asking the tough questions and that VP of sales is prepared for those questions at the board meeting, boy, it's going to make it a lot easier and more comfortable board meetings. So, Lyle, I appreciate very much. Your insights are very keen. Your experience is significant. Very few CFOs have been through as many different hurdles and challenges as you've seen. I think this is going to be quite informative to a lot of folks that are watching this interview, and I know that people would be happy to talk with you. How's the best way to reach you if someone's interested in learning more about your background and what your interests are?
Oh, gosh, John, thanks. That's a great question. Of course, I'm on LinkedIn like so many people are. I'm active on LinkedIn. You can find me, Lyle Newkirk. I'm sitting out there. My most recent position is Corrigo and JLL. So I'm there. Look for me there. You'll even see my smiling face on my LinkedIn profile. You can also reach me at lylenewkirk1@gmail.com. And my phone number is 678-749-4842. And I'd love to hear from anybody with any kind of questions about any of this material or anything else.
Great information. We appreciate it. And thanks for everything you've done in the tech community.